Good afternoon and welcome to the Asian Midday Market Watch. Our guest today is Kelvin Wong, market strategist at CMC Markets. Kelvin, as always, thanks for coming in.
Sure, my pleasure, Brian. Good to see you again.
Now, before we start, let's take a first look at crypto markets and see how the various coins are performing. We've got Bitcoin, which is at 64,621.1. It is down 3.03%. Ethereum is at 4,635.15. It's down 1.66%. Binance coin is at 606.7. It is down 2.38%. Tether is at 0.9998. It is down 0.01%. And Solana is at 239.315. It's up 0.44%. Now, looking at regional markets, we've got the Nikkei, which is at 29,226.65. It's up 0.41%. The Shanghai Composite is at 3,513.15. It's up 0.59%. The Hang Seng is at 24,958.28. It is down 0.15%. The ASX 200 is down 0.65% at 7,375.70. Kospi is at 2,911.5. It's down 0.62%. Closer to home, we've got the SGX, which is unchanged at 3,231.26. And Bursa Malaysia is down 0.07 at 1,519.62. Now, Kelvin, what's your view on market performance this morning?
Well, I will say that okay, because if you look at yesterday's reaction from the U.S. stock market, is pretty bad because if you look at the major U.S. stock indices from all the way from the SPX 500, the Dow Jones, the Nasdaq 100, and even the small cap Russell 2000, all recorded losses. All right, so. If you look under the hood of the picture over here, is that actually it's not so bad. If you look at the various sectors, not all the sectors are in the red. The one that is causing the drag on the US stock market is actually the fact that we call it the big tech stocks, because they are more prone to inflationary pressure. That means we start to see higher inflationary lead to a kind of a push up in longer dated government bond yields across the spectrum. Eventually, cost of funding will be higher, which will tend to be detrimental to these high tech stocks. So given that high technology stocks has a higher weightage in the major US stock indices, especially the SPX 500 and as well as the Nasdaq 100, so that's why we start to see a drag on the major stock indices. But under the hood, our still relatively healthy. Number one, if you look at the SPX over here, it's still holding above the key major medium-term support to actually support a potential multi-week up move that's still in play at 46.25, still holding above that level. And yeah, definitely we start to see a scare in the inflationary numbers. But if you look at across Asia, it's holding relatively well, I would say. So if you look at Hang Seng itself, Hang Seng is actually one of the weakest in terms of laggers, I would say, in the Asia Pacific region, due to this ongoing concern about this debt crisis in the China property sector. So as you know, the evergreen is an issue. So, but however, if you look at Hang Seng index today, is still holding relatively well after yesterday a test of that 24,550 key medium-term support. So it's holding as well, even at the Nikkei 225 as well, which is at 29,070. Then going across to Europe. So Europe holding relatively well, the DAX above the 15,785 key support level, key medium-term support level. So I would say it's more like a pullback on the US stock market rather than the start of a so-called multi-week or major corrective decline phase.
Okay, but Kelvin, I gotta ask you this because US consumer prices, although they jumped in October, there are indications that inflation may be peaking. Why is that?
Okay, because there's one side of the camp over here is because we are saying that number one, as long as the initial supply shock that is kind of being undertaken by this, one of the reasons is that due to the pandemic, the situation of this pandemic scenario in the last 1 year or so, as more economy starts to open up, this global supply chain crunch will slowly get abated. So that could actually, we call it, they say peak inflation, where I call it number one, producer prices will start to come down globally, worldwide, which eventually will be a good sign for consumer. So that is one camp of the story. But other camps of the story, right, we got to understand over here is that number one, this global supply chain thing is it includes all countries to play a part of it. Okay, yes, we start to see the Western world starts to actually open up their borders, but one main jigsaw puzzle inside this global supply chain crunch is actually China, because China now, if you look at the last few years, it has been a major player inside this global supply chain in terms of
Yes.
semiconductor, in terms of raw materials. So if you look at China right now, it's still advocating a COVID zero strategy. So as you could see that this week they start to actually re-implement stringent measures due to a new infection outbreak in the northern part of China. Now seems to be spreading towards almost towards majority of the states in China. So if as long as China continue to advocate this COVID zero strategy going forward into next year, I would say that there is still risk of heightened inflationary pressure to be trickled down to the consumer side of the story here.
Okay. Now, I want to take a look a little bit at the impact of the foreign exchange markets post
Yes.
inflation data. I'm going to put up a chart here, and perhaps you can talk us through it.
Yes, sure. So, if I were to look at this chart over here, right, it's actually the dollar yen chart, which is the dollar versus the Japanese yen. So, as you could see that yesterday's US inflationary number is pretty hot, scorching hot. So, talking about the CPI increasing to a level that is not seen since November 1990. So that's talk about close to more than 10 years, man. So
Yeah.
the key thing over here is the dollar itself has been relatively weak against other major currency, like for example the sterling pound and the euro dollar. All right, because one of the reasons we don't forget, we are looking at foreign exchange, we got to understand the different government or different central bank monetary policy. Okay, so as you all know that number one, the Japanese central bank, if you look at the latest monetary policy, they are still very dovish. They are still keeping their
Yes.
JGB target close to 0%. They are very less reluctant to actually normalize their what I call ultra dovish monetary policy. That means that they keep interest rate as low as possible in even into until end of next year. So that
Mhm.
actually could actually add further upside pressure on the dollar versus the yen. So as you could look at this chart, right, this is a weekly chart. So we start to see over here the reason we got the 5-year high since June 2015. It's been trading downwards. But what's interestingly over here is the breakout on 4th of April this year. There's this bullish
Okay.
breakout. So what we could see over here is a breakout of a major resistance level of this descending trendline resistance that is capping previous rally since December 2016. So what we could see right now over here is based on yesterday's US strong inflationary number, it's now attempting to retest this 1114 1114.40 level. So if this start to see a breakout, right, we could see a further potential up move from a multi-month perspective, because this weekly chart, so probably about 1 to 3 months
Okay.
to actually set sign on the next resistance level at 118.70, which is this former major swing high of December 2016. So all in all, right, what we could see is the technical picture seems to be positive on the dollar against the Japanese yen, because number one, it's supported by the divergence view of US and Japanese central bank monetary policies.
Now, Kelvin, thank you very much for your insights and for coming on the show.
My pleasure, Brian.
Now, we've been speaking to Kelvin Wong, market strategist at CFC Markets, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. This video and podcast will be on our various social media platforms as well as our website, www.biztech.asia. Please like and subscribe to our various platforms. Thanks again for tuning in.